Okay, folks, welcome to the Contrarian Trader. This is Robert Desmond. This video is for the new to moderately experienced investor, although if you have a substantial amount of investment experience, you might gain a different perspective on the market, so I think there's value that can be gained from anyone viewing this video. So if you have substantial experience in trading stocks and it seems a little bit elementary for you, it's intended. You may be asking yourself, why am I starting off this video on stock twits, looking at your twits? Well, the reason is that I like to put myself out there. I have a tremendous amount of competition. I'm in the same business as traders such as Tim Sykes, Jason Bond, a number of other stock services out there. I own the contrariantrader.com. However, unlike my competition, what I like to do is I like to make macro calls in the market, put myself out there, and people judge for themselves whether or not I am making the proper calls on the market. And if they're in sync with my philosophy, then they can trade along. And on April the 2nd, I posted two individual twits. One was a link to a video that I prepared. It's still there. It's called Sell Stocks Now. It's still posted there. The other is this, and this is true. I rarely make frantic calls on the markets, but my suggestion is to get out now. Sell. So what happened after these calls? What happened is that the following day, we went into a correction on the market, pulling back to below the 50-day moving average. We have since rallied, and you might be asking yourself this. I was shorting the IWM. This is a daily chart of IWM. I apologize for not saying that originally. What you might be asking yourself is this, Bob, are you now currently net long of this market as we break out to new highs? My answer to you is unapologetically no, I am not. And I'm going to go into those reasons of why I am not in a few minutes. But for those new to the markets, I want to point out a few charts and get away from just a simple stock charts and go to charts that really should illustrate to you just how rigged this market truly is. What you're looking at here in red, this red line here, is the viewership of CNBC in the demographic group 25 years of age to 54 years of age from March of 2004 to December of 2012. Now you can see, coming out of the dot-com bubble, which is not reflected on this chart, viewership was in a dramatic decline. As the markets bottomed out and we began to rally into the new bubble, the housing bubble, which we know burst, and we peaked out here in viewership in 2008. We have pulled back. So we know from this chart that bear markets are not good. Here's .com. Here is financial crisis. Bear markets are not good for CNBC viewership. Why? It's because they can't charge a lot of money for advertising. And as you can see here, this is as of December 2012, the market, as it rallied to ever greater highs, CNBC viewership never recovered. It continues to break down. So you have to ask yourself, what is CNBC hoping for? What must they do to create an inflection point where you have the average investor come back into this market and buy stocks and watch CNBC? What they need to do is every day announce a new high on the S&P 500 and on the Dow Jones. Hope that it filters down to the small investor, get them excited, and have them come back in. Guaranteed, when that happens, that's when the large money, the big institutional money, will begin to rotate out of this market. And in a minute, I'm going to show a chart of exactly of that happening right now. Let's move on to why I'm bearish on this market. Only a few charts. Annual change in real U.S. wages. We have the retail holders making all-time highs, meaning the retailers are doing great. The stock prices are ever soaring. However, this is a chart. Annual change in real U.S. wages from March of 1998 to present. March of 2013 is in a dramatic decline and in fact went negative. And it can go negative adjusted for inflation and somebody not getting a raise. So This is the state of the consumer, yet the retail holders continue ever higher. Why else am I bearish in this market? Take a look at this chart here. Average performance of the day by S&P 500 since November 2012 lows. Mondays, generally a negative day. Tuesdays, by far the biggest gaining day of the week since November of 2012. We've had 17 straight Tuesdays of up gains in this market. And I'm doing this video on May the 11th of 2013. This traditionally, Friday, I'd call this short covering Friday because many shorts, they cover their short positions on Friday so they don't have to worry about Mondays. But that dynamic seems to have changed because Friday, which is now second in being an up day, is now been replaced by Tuesday as being the up day. So this is all algorithmic trading. This is all a manipulated market. You think that it's purely coincidence that Tuesday is the major up day in this market? Hell no. Take a look at the chart of the S&P 500 here in blue. A beautiful, beautiful chart. We're making all-time highs. This is as of April 2013. In red here, if you took out Tuesdays, S&P 500 from November 2012 lows, X Tuesdays. If you take out Tuesdays, this market, if you draw a trend line down, has yet to break out. So, whatever they're doing on Tuesdays to manipulate this market up higher, it's selling advertising. It's keeping this market going. And what is the crux? What is the proximate cause of this market going higher? Take a look at the effects of QE on the S&P 500. This chart here is just one of my favorite charts. S&P 500 performance during Fed Open Market Committee action March 18th, 2009 through March 1, 2013. And here in red, you have QE1, resulting in a 47% gain in the S&P 500. QE2, here in green, resulted in a 10% rally in the markets. Operation Twist resulted in a 16% gain in the S&P 500. Operation Twist, which was extended, and now QE3 resulted in a 5% gain. QE4, which we are currently in, a 6% gain. That was as of March 1. We're higher than that right now. Now, stock prices are higher, no doubt. But let's go back to this chart. How's the average consumer doing? Is QE a success or a failure? I'll leave you with that thought. Now, let's get back to this chart and take a look at the S&P 500 with no Fed intervention, meaning the Federal Reserve sat on their hands. Yet interest rates were still at historic lows. Negative. The stock market declined. No policy, here in gray. The stock market declined. This stock market is in constant need of Fed monitoring because our thug congressmen, legislators, and president cannot get policy right. In fact, they're making it worse. Take a look at this chart here. S&P 500 performance with and without QE. We, of course, with QE, positive. Without, we'd be negative. Now, why am I short of this market? Because I believe that when this market goes, it's going to fall so hard, it's going to make your head spin. And we're already seeing the setup for a major, major decline in the market. That doesn't mean you should go out tomorrow, sell all your stocks, and get net short of this market because they can play this game for a while longer. But at some point, it's going to come to an end, and when it does, it's just going to be horrifically horrible. That's redundant because I want it to be. It's going to be a nightmare. Here is a chart of margin debt. And as you can see, the S&P 500 here in gray, margin debt in blue. This is the dot-com bubble right here, and this is the housing crisis bubble, the banking crisis, or whatever you want to call it now, back in 2007, 2008. Here is us now. We are at historic highs on margin debt, which has proven to be, time and time again, a harbinger of bad things to come. Let's continue with why I'm bearish on this market. S&P 500 weekly chart. A tremendously beautiful chart. I mean, outstanding. Really outstanding. But take a look at your volume. As we're making all-time highs, volume is just dropping off a cliff. Here in red is the average weekly volume. It can't even make average weekly volume on a stock market that is breaking out to all-time highs. And they can keep this going. Don't think that on a Monday morning or Tuesday morning, especially Tuesday, because that's guaranteed now to be an update. Don't think that they're just going to let this market fall apart. The other thing on this chart here, this is your money flow index. Note, let's change this. I'm going to move this indicator up. Okay, this illustrates my point better. Money flow overlaid with the price of the S&P 500. Note how we are making all-time highs on the S&P 500, yet money flow is dropping off of a cliff. Intuitively, you would expect that as the stock market makes all-time highs, money flow, as is tradition, is making newer highs as well, but it's not. It's not happening. And for that very reason, I refuse to get net long of this market. Let's take a look at the chart of the retail holders. This chart to me is stunning. Remember the chart about wages going back to 1998, in decline, now negative for the average U.S. worker. Here's the retail holders breaking out to all-time highs. It broke out above the upper band of its pennant formation. We have an RSI, relative strength indicator, of 81.28, which for an index is just nosebleed overbought levels. And most importantly is this. Take a look at your volume in 2013. Just as bad as volume was in 2012. It's off a cliff. And compare it to volume going back to 2011, 2010, 2009. Volume on the retail holders as we break out to all-time highs is simply non-existent. And when you contrast that to margin debt, you need to ask yourself a question. When this bubble breaks, and we are entering a bubble, because remember, year-over-year earnings are in a decline. Year-over-year revenues are in a decline. And you may have just heard, as we exited earnings season, that companies beat on earnings. That is an absolute falsehood. Analysts purposely underestimate earnings so that they can go on CNBC, or companies can come on CNBC and say they beat estimated earnings. Compare them to prior quarters, compare them to prior years. Don't tell me that you beat an analyst earning who 60% of the times miss earnings, yet they make over $150,000 a year plus bonuses. You don't think this game is rigged? Getting back to volume, as I pointed out in the retail holders, getting back to margin debt. What is going to happen to this market when the bubble finally bursts? Well, in the case of the retail holders or another lightly traded indexes, who's going to step in and buy a market that is in devastating correction? While you don't even have big buyers coming in now in a massive bull market. What's going to cause accelerated selling, like a snowball running down a hill, growing ever bigger, is going to be this bust of margin debt. These people at some point in time are going to have to cover their debt either with cash equal to their current positions or twice the value of the current market positions they hold. They're going to have to sell stocks. And when they do that, markets are going to dramatically fall until we finally bottom out on margin debt. So in closing, I'm not saying on Monday morning go out and sell stocks. I'm just saying you should be building a short position incrementally, not going out all at once, nibble, nibble, nibble. You make a profit on the long side, take those profits, get a little bit short of this market. Start building that short position because everybody always wonders, as illustrated here in this chart of the IWM, who was intuitive enough to be short back in the dot-com bubble? Who was intuitive enough to be short the housing bubble here? The same could be said now. Who is intuitive enough to have been short here when the bubble finally bursts on this market? It need not be the Federal Reserve taking their foot off the pedal. It could be a geopolitical event. It could be any number of events that occurs that causes the bubble to burst. And more than likely, we won't know what it is until it finally hits us in the head. And we wake up on one Monday morning and the futures are down 500 points. So I just urge you, don't be blinded by the CNBCs of the world. View their interviews, but understand that they have a vested interest in the markets heading higher, not lower. And that's it, folks. On Sunday, I will be releasing the week ahead commentary to members. It's an overview of where I believe the markets are heading in the coming week. With the contrarian commentary video, on Sundays, I'll be sending out a second video focusing on stocks that we currently hold and stocks that we're looking to trade. If you're a member of the Contrarian Trader, you'll receive that every single Sunday. There's a 14-day free trial offer. Please take advantage of it. Hope to hear from you. If you have any questions, please send me an email, robert@thecontrariantrader.com. All the best. Be safe in this market. Trust me, the stock market, there's no better place to make money. Low barriers of entry, lots of liquidity. And that makes for a great, great business opportunity. However, you need to play it smart. That's it, folks. Have a great, great trading week. Talk to you soon. Bye-bye.